Hello and welcome. This is part three in our Intro to Investing series. If you want to go back and watch the first couple, they are available as well. So, part one was what are stocks and bonds? Number two was ETFs, mutual funds, index funds, and some alternative investments. And then today we're going to get into some common pitfalls, what's the sort of risk versus return aspect of investing, a little bit about diversification. So just some other concepts that are relevant in the investing world and how to think about them. Again, if you haven't been on these before, my name is Danica Waddell, and I am the founder of Xena Financial Planning. All right, so let's get into it. So some common pitfalls when it comes to investing include, number one is overtrading. So what is overtrading? It just means you're buying and selling things a lot. So one of the things we talked about on the last session was, the idea of investing for the long term. And when you zoom in, you kind of see a lot of choppiness, but when you zoom out, tend to see more of a, it's not a straight line, but your portfolio does increase over time. When you overtrade, you really eat away at your long-term returns. So the less the less trading that you do, usually the better. Obviously, there's some trading that needs to happen to, as you have new assets that come into the portfolio, you have to get it invested, or occasionally you have to rebalance. But overtrading is something that tends to really detract from your long-term performance. Chasing the next hot stock is another one that's kind of in the same realm. So if you're paying much attention a couple of years ago to the GameStop phenomenon, there have been other things like that where there's a particular stock or there's a particular sector of the market that people are really excited about. And typically we want, again, a long-term strategy that's consistent. And so kind of going for whatever your next door neighbor or your coworker is like, oh, this is the thing, is usually not recommended. The third one on here is stock concentration and lack of diversification. So if you do work in the tech sector, many of our clients work in the tech sector, and they, receive company stock as part of their compensation. That's very common. It's also very common for people not to sell that company stock. And then a few years in, all of a sudden, 75% of their portfolio is in Amazon, Microsoft, Meta, insert the company name here. Why is that not a good thing? Well, because, a single company has more exposure in terms of it's riskier. So the more that you have of your portfolio in one specific stock, the more risky that is, the more volatile your portfolio is likely to be. And, your entire net worth could, come down just because your company didn't do well, as opposed to, if you have a diversified portfolio and one company doesn't do well, it doesn't really have as big of an impact. Emotional decision making. So this is something that people in my line of work are becoming much more attuned to and really studying a lot, because it's such a big part of investing. And we all like to think that it's that we make rational decisions and that we just look at the numbers and it's all very straightforward. And the reality is, many of us get anxious when the stock market is down. Many of us feel good when we log in and our portfolio is up. Like, that's a natural thing to be influenced emotionally by what's happening in your portfolio and in the stock market and the economy. So realistically, we're never going to remove emotion from just how we approach our investments and our portfolio, but being cognizant of that and knowing how to manage it is important. So if if in 2008, actually, I'm going to show a slide in a minute about the great economic crisis of 2008, and a lot of people really panicked and pulled their money into cash. And again, I will show the long-term ramifications of that, but it's not good. So you want to try not to react as much as possible. And then the last common pitfall is sitting on the sidelines. So I see this all the time where, I'll start working with a client and they'll say like, I've been accumulating this money in savings, but I didn't know what to do with it. Or I inherited some money and I've just been It's just been kind of sitting there. And the longer that you wait, the more that you're just missing out on potential growth. So the longer that you sit on the sidelines, the bigger of an impact that might have. But really, ideally, you want to get money. If you do come into a sum of money, usually it's better to get that invested sooner rather than later. Okay, so this is the chart I was talking about that demonstrates the impact of kind of, one single person, let's just say, hypothetical person that had a 401k balance going into the great economic crisis of 2008. And you can see on the left-hand side, right around $100,000 or so. And then in the crash, it goes down significantly, of course. We all remember that. But the chart on the right hand side then shows, what could have happened if there's three different scenarios. The one at the top is the light blue, where that person did not change their allocation of their portfolio. They didn't sell anything. They just said, you know what? I don't need that money anytime soon. My 401k is going to rebound. It's totally fine. So they leave it alone. So, whatever we're looking at 10 years later, I guess, so to 2018, that portfolio rebounded, it came back, it's now worth 238,000. The dark blue line is somebody that took all of their money, cashed in all of their investments in their 401k. So it's just 100% sitting there in cash. But then 1 year later, they got back into the market. So they presumably just went right back into the portfolio they were in. And so now, 9+ years or whatever of being invested later, their portfolio, that portfolio is now up to 155,000. So pretty big difference between the light blue and the dark blue, but at least that dark blue person, they did get back into the market. They just took a year on the sidelines. The last one, that green one, is the person that just went to cash and stayed there. And so their portfolio is at $55,000, never changed again. So you can really see a dramatic difference between those three potential paths, I guess, from, somebody that saw a big drop in their portfolio and in 2 out of the 3 cases kind of panicked. And the worst case is just that green one where you just never get back into the market. The absolute perfect one, of course, life is not perfect. Life is messy, but that light blue, example is the person that just left it alone, didn't change anything, and they benefited long term. So a little bit of what we're seeing with, some of these charts, kind of, especially as we look at performance over long term, is the benefit of compounding or compound interest. Compound interest is sometimes called the eighth wonder of the world. I think maybe that's overselling it just a tiny bit, but it is really powerful. And so what we can see when we look at some of these charts is, dramatic increase. It's just maybe it's 5% or 7% year over year. But when you look at that over 30 years, it's really significant. So the main takeaway about compounding in general is that it's more important to get your money into the market as soon as possible rather than trying to time the market. So the saying I have on here, very common in the financial world, is to say that time in the market is more important than timing the market. And so again, that just means the sooner you get your money invested, that means it has more time to grow rather than trying to decide like, it's now the time. No, it's now the time. That's usually not going to pan out long term. So almost always, the longer that you can stay invested and leave your money there, the better. Okay, and then this is just a really great slide about compound interest and what sort of how different that can look in terms of time frame. So again, we've got 2 different people here. The person on the left, the blue, is investor number 1. So they start at 25 and they invest $5,000 a year, 10 years in a row. Never put another dollar in. So for 10 years, they put in a total of $50,000. When they go to retire at 65, that portfolio is now worth $787,000, right? That's huge. So, and you can see at the bottom, I don't know how well you can see on your screen, but the chart is based on an average rate of return of 8%. Every single year is 8%. The investor on the right started at age 35, so they didn't start as soon, right? 10 years later, but they also invested $5,000 a year. But they never stopped. So the person on the right actually invests for 30 years, so $5,000 a year for 30 years is 150,000. So they invest a whole lot more than the person on the left. But when they go to retire, they only have 611,000. So again, that power of somebody being able to invest at 25 for 10 years really was even more significant than, the person on the right invested a lot more, but they just started later. So this one I think can be really helpful in terms of getting you to invest as soon as possible. So if you are in your 20s and you're able to just put a small amount, it might not seem like very much, right? It might not even be 5,000 a year. But anything that you can get in to the market and stay invested for 40 years or however long it is until you retire, the power of that compounding over 30 plus years is really dramatic. Um, so I think that's actually where we're going to end today. I was going to try and cover risk and return as well, but I think this is long enough, and we'll pick up on some of the other concepts in the next video. If you have any questions that you'd like us to address, feel free to send them to hello@zenafp.com. And just want to make it clear that this is for educational purposes only. So you should consult with your financial advisor or tax advisor to get specific recommendations for your portfolio. And we'll see you next time.